If you're thinking what to buy from this market crash, maybe today's discussion will have some findings for you. Let's recap what has gone on, especially in the crash of 5th of August 2024. Nikkei 225 actually plunged massively. Nikkei is actually the Japanese index. And you see over here that it had its worst day since 1987, plunging more than 12% on that very day. The subsequent day saw Nikkei rebounding massively, and this kind of volatility is really unseen. If you look in terms of Bitcoin, it's also crashed by 14-15%. But the surprising part is the Holy Magnificent Seven. They have also crashed, and I'll cover them a bit more in detail. If you see over here, what I've put up for you is the 5 times long Magnificent Seven, which means a leveraged ETF. And for an investor or trader who has bought this ETF, this crash will have wiped out their capital. Again, a quick reminder, avoid leveraged ETFs because with extreme volatility, you could see very big losses. Maybe you're unaware and thinking, the world is no longer borrowing, interest cost is so expensive. Why would someone do margin trading? Actually, that's quite far from the truth. Yes, Fed right now is 5+%. Yes, also that most developed countries have followed Fed's direction, such as the Australian Central Bank, as well as the European Central Bank. But I don't know if you know this, Japanese Central Bank and Swiss Central Bank are still keeping their loans really cheap. This is the latest interest rate table, something I've shared before in last year's Joshtan Finance Summit. I actually called for warning on Japanese yen carry trade unwinding. If you have came down for the event, leave in the comment sections, and right now we are seeing it play out in real time. What you can see over here is that if you borrow in Japanese yen, you're only paying 0.25%, correct? Cheap loans like back in the good days. Swiss Central Bank, only 1.25%. If you're smart enough to guess, you would realize that many people are borrowing in Japanese yen and Swiss franc, and what they simply do is to park it into US Treasury bills, earn 5.5% while paying only 0.25 or 1.25%. Very smart, correct? Not quite so. Carry trade has been around for many years. Previously, in 2008, there was a massive carry trade unwinding with the global financial crisis. This time round, quite obviously, US at 5.5% is the safe haven to do this carry trade. But why did everything unwind so quickly? Recently, jobs report for US came out very bad. When there's a carry trade, it only takes a small rumor or a small change in forecast for everybody to stampede out. And this data point clearly suggests that US could be seeing a recession maybe 6 or 12 months down the road. That is why the expectation that Fed will cut rates is now becoming the new consensus again, and is a guess of how aggressive it will be. US dollar, as you can see over here, matched against Sing dollar, saw a massive decline. Everybody is selling US dollar assets to move away from it. If you have US Treasury bills or you park into money market funds in US dollar, take note again, your high interest rate comes with forex risk. So when US dollar sells, what goes up? This over here, Japanese yen. I've mapped it against Sing dollar, which is a relative neutral currency, and what we can see is Japanese yen has spiked up massively, correct? Which means everybody is buying Japanese yen crazily. This is because they have loans in Japanese yen, and when the currency spikes up, your loan becomes increasingly more expensive, and this spike is already 8 to 10%. The graph below shows you in a format where you can understand a bit more. Many of us have been to Japan recently for a trip, myself included, and back then, the Japanese yen that I exchanged with was about 111 to 112. Right now, Japanese yen has dropped from 119 all the way to 109 in a few quick weeks. So if you're going to Japan for holiday in December, expect a higher Japanese yen moving forward. The Japanese yen unwinding is coming to the forefront, but why did I know about this carry trade? It's quite simple. I work in the financial sales industry. For the last 1 year, I've been pitched this idea of getting clients to borrow in Japanese yen. If you have worked with a private banker, you would have heard of that pitch also. I've not placed any of my clients' monies with margin into Japanese yen because to me that was a risk that was not worth taking for retirement planning. Personally, I put my hand to my heart and not advise clients to take such risky moves. If you think I can help you and like my style of planning, look for my links below. And to round out this section, Swiss franc, which is the second cheapest loan to borrow, has also skyrocketed in the last 1 week. If you're taking loans in Swiss franc, do be wary, you may be seeing a bigger monthly cost. So this entire thing of carry trade unwinding, What are assets that are being impacted and what are assets to start buying? Let me start by touching on Nasdaq. This is a quick chart to plot USD against Japanese yen versus Nasdaq. As you can see, the correlation is very high. It tells us again, many people are borrowing Japanese yen, especially institutions and wealthy individuals who have been advised to do so, and they are plowing into technology stocks. I share with you my observation and you decide whether it makes sense or not. In the last 6 months, Nasdaq has underperformed the more diversified S&P 500 already. In this graph also, you'll see Magnificent 7 still outperforming on a 6-month basis, but it's coming down fast. How fast? If you look in terms of the 1-month chart, Max ETF, which tracks Magnificent 7 on an equal basis, has came down by 15.23% already. This tells you again there is a lot of hot money going into big tech, which supposedly is a safe haven and a place that investor can do no wrong. But I want to go into particularly one company, which is Nvidia. If you see over here in this map of 1-year performance, Nvidia has delivered 129% already. Magnificent 7 only 32%, which is still a fantastic rate of return, by the way. This graph tells us that Nvidia has single-handedly pulled up the entire market. It's actually crazy to think about it. And this hype is even bigger than Tesla's a couple of years ago. And when Nvidia did a stock split in June 2024 of 1 to 10, it gave it another leg up when AI was already seemingly old news. I plotted in this chart SMCI, which is another AI hype company. But as you can see, it actually peaked out in March 2024 after a rapid surge up. Nvidia, on the other hand, continued to rise, maybe because of the stock split, which leads me to think, could Nvidia follow what has happened for Tesla back in August 2021? If we think back in history, Tesla actually had a stock split of 3 to 1 and it ran up after the stock split with wow optimism. Based on what we see from Tesla's stock performance, the first leg down may not be the end. There may be a surprising upcoming run up to pull up everybody who's late to the party. But subsequently, there will be underperformance for the next few years. Again, I pull back up this chart to show you Nvidia. Could it shoot up a little bit before settling down with negative performance for next few years? That is something nobody is expecting. Everybody is thinking Nvidia will double from here. And from what we see from Tesla's story, it became a minus 15% for the next 3 years. Now let's switch gears to talk about REITs and banks. Let me plot over here DBS, OCBC versus Mapletree Industrial Trust and CICT. I want to paint a story of what's going on. Over here, we can see from start of July, there was news that inflation was coming down in US. That's where the first hope of rate cut actually came back in. What we saw is that REITs started to recover and bank shares started to sell down slightly. This again is a 1-month performance. Prior to that, banks have outperformed REITs undoubtedly by a big margin. Then fast forward to today's news that the economy could be bad 6 to 12 months down the road. That's why whether it's REITs or banks, everything was sold down. The expectation of interest rate cut is increasing, which in theory benefits REITs because it has loans and maybe tailwinds to banks who might see a compression in net interest margin. That is why on a 1-month basis, you can see that most quality REITs are actually in the green. The top few again are those very distressed, which we will not cover too much. Beyond that, Capital DC has done well. Mapletree Industrial Trust and Fraser Centerpoint Trust, which is what I own, have actually recovered a bit. That is why also on 5th of August 2024, when markets crashed, I've actually bought more of Mapletree Industrial Trust and IFAS. These are two that I'm still accumulating with my own spare savings. And what I'm trying to convey to you is that when market crashes, it could be an opportunity for you. Have a plan in mind, be brave and execute. And also with the expectation that market may not be in your favor for next 1 week or 1 month even. So buy slow and steady or have a dollar cost averaging system on hand. Then what about bank shares? The plunge in bank shares is very steep, correct? Is it an opportunity? Or Josh, why aren't you buying DBS yet? Firstly, I'm not against DBS. I don't know why my previous episode on I'm not buying DBS became misconstrued. I will buy DBS in future, but in general, I still think banks will see headwinds in terms of their margins. In addition, it's very important to note, banks are inherently very cyclical. if there's indeed an economic crisis or recession, banks will see a drop in terms of loans, and not just that, the default rate on what they have on the loan books start to increase. That eats into the profitability. But let's pull up the chart for DBS. Right now, price has corrected back to when the bonus was declared. Again, it rewards for an individual to be patient. Market crashes do come about. Over here, it's quite obvious that there are gaps in terms of the price for DBS. For it to trade upwards, pretty easy. In fact, there's a 200-day support at around $33.60. Typically, this is a very strong support, and I wouldn't be surprised for it to trend upwards for the coming weeks ahead. In addition, DBS has actually released very good second quarter 2024 results. If you're keen to hear an update on DBS, smash the subscribe and stay tuned for it. I will be covering it for you. As always, if you missed my previous episode on DBS, this is a 2-part series. Check it out and I'll see you there too. Invest safely as always. Take care and goodbye.